Pay 10% tax now or 35% tax later. It's your choice, my friends. Either way, taxes will be paid. You got to think about it. Do you want to pay a little bit less today or a lot more in the future? We're going to talk about it here in I think it's chapter 11 of my book, The Tax Bomb in Your Retirement Accounts, how the Roth IRA helps you avoid it. So we're chapter 11. 10% now or 35% later. So welcome to Heritage Wealth Planning YouTube channel, my friend. Don't forget to subscribe right there. You see that little, that's a pillow back there, believe it or not, which is actually pretty cool because it reminds you some mind control there. We're controlling your mind. So, oh yeah, better subscribe. Told Josh's YouTube channel and we're telling you subscribe. And once you do, don't forget to click it's on this side. I got flipped around. It's on that side. Don't forget to click that little bell to be notified for future content. All right, so let's dive right into this. This is kind of exciting. That does bother me, the idea that you will never pay tax on a Roth. You're absolutely going to pay tax. You're going to pay tax. Get this through your head. Taxes are going to be paid. I'd rather have you pay 10 now than 35% later, if not more. So let's talk about this. We're going back to John and Judy. So remember these guys. John and Judy, after John died, Judy lived rather frugally, as do most retirees, I might add. So when she died, she still had $200,000 in her IRA, which she left to 50% each to her two children, Jenny and Jimmy. All right, so she has a $200,000 IRA, $100,000 goes to Jimmy, $100,000 goes to Jenny. Jimmy is a married radiologist making $500,000 a year. Jenny is a divorced gas station attendant making $35,000 a year and heavily in debt. Two completely different situations here. Jimmy has no cash flow needs, so he rolls $100,000 that Judy left to him into an inherited IRA. Now, on an inherited IRA, you still have mandatory distributions, even though you're not 70 and a half. If you inherit at 2 years old, you have mandatory distributions. Now, these distributions aren't much because you're young. In this case, we're saying Jimmy is 50 years old, but he still has them. And given his tax bracket, when he's making $500,000 a year, he's going to pay 35% to Uncle Sam alone. That's before his state. If he lives in California, it's even going to be worse. So we know Jimmy is going to have to take small RMDs, but he's still going to have to take them, and he's still going to have to pay tax on them. He's going to lose probably close to 40 cents on the dollar. Now, Jenny, on the other hand, she's desperate need of cash. Like I said, she's heavily in debt. Creditors are calling, and she's late on the rent. So she takes a lump sum distribution of the entire $100,000, which puts her gross income at $135,000. She has $100,000 from Miss Judy, adds to her $35,000 of earned income. Now she has $135,000 that she has to report to the tax man. Her total tax is going to be almost $24,000, again, before any state taxes are considered. And so that means she's going to lose nearly 25% of Judy's IRA that she left to Jenny. 25% gone to Jenny, and there's no more of that after that because she just used it all. And Jimmy's going to lose over time. He'll lose 35%, probably actually 40% when you factor in the state taxes, if not more as well. And so basically 35% of this account will be lost to taxes that John and Judy could have had and could have used. They could have used it more so than giving a third of it to the Uncle Sam and the various governors of the states that they live in. All right, so now you got to figure out, do you want a tax-free inheritance or a taxable? Regardless if you're a high-income earner like Jimmy, who doesn't need the cash, or if you're a low-income earner like Jenny, who desperately does, wouldn't you rather have your inheritance go to your kids tax-free as opposed to the proceeds going to the federal treasury or your state treasury here in Atlanta or whatever state you're in? If John and Judy had left their children Roth IRAs, every single penny would have gone to them tax-free. Every single penny, and none to the IRS. All that was required was from them to have done a bit of tax planning on the front end. That's all they had to do. But again, everyone says, oh, defer taxes, defer taxes, defer taxes. Yeah. Deferring, it just simply means someone else is going to pay it in the future. That's all it means. Now, if you're married, filed jointly, and you defer until your spouse is a widow or widower, she or he will pay taxes in the future more so than he or she would have when you were alive. Now, if the spouse dies, like in this case Judy did, she will defer the taxes to Jenny and Jimmy, who are going to pay more taxes because Judy and John were retired, probably not making hardly any money with hardly any taxes due. And on top of that, On top of that, now they're going to have their own income tax to pay, as we saw by Jimmy with being a radiologist making $500,000, or Jenny who needed the cash and took a lump sum distribution. It's bad. Hold on, Jim. Yeah, when my daughter's just texted me, she needed an Amazon code for something she's trying to buy. What's that about? So I had to pause you guys to take care of my kids. Interesting, isn't it? Kids, what are you going to do with them? And so we're talking about leaving your kids even more money, even though, man, they'll make you broke. I'm talking about how to leave your kids more money, and then I get interrupted. Well, my child needed more of my money now, and I'm not even dead. Anyway, the love of being a parent. I wouldn't have it any other way, my friends. I'm telling you, I'll go broke, but I'll never trade in the smiles I have for my children. All right, side note. The thing about being a dad is that you get to be goofy, and everyone expects you to be goofy, and no one cares except your wife and your kids, all right? So your wife and your kids are always like, Dad, it's so embarrassing, your daughters in particular. But, man, no one else cares. You could be sitting on the subway being goofy with your kids, and everyone's like, that dad's so cute. It's fun. It's just fun. It keeps you young, man. I tell you, if you're thinking about being a dad and you're concerned about it, dude, don't worry, man. I'm telling you, at the end of the day, it's going to take care of itself. Now, listen, if you think about being a dad and you want to make sure your kids have all the prep schools and all this and all that, they're playing, semi-professional sports, that's not for me. I mean, more power to you. I don't get it. Just let your kids run around. Let your kids watch some TV. Let your kids play. It's cool. All right, so enough of that. Just real quick, there's a book called by a guy named Brian Kaplan, Caplan, something like Selfish Reasons to Have More Children. It's not as bad as you think. I can't remember what the tagline is, but Selfish Reasons to Have More Kids. What a wonderful thing, because it's just like, look, at the end of the day, just let your kids be kids, man, and stop sweating it so much. They're going to turn out fine, as long as they know they have a raised by you with showing your values. And whatever your values are, more power to you. All right. So let's see. So be advisors. No getting around paying a tax, which I already talked about. Someone is going to pay the tax, but with proper tax planning, John and Judy may have been able to pay tax at 10% or even less than which they would have allowed their kids to avoid losing a third or more of inheritance to taxation. Now, not inheritance tax. I will do videos on that. I guess got to get around to it. I just got to finish through this book first. But they would have lost money to income tax, not inheritance tax, not estate tax, income tax. The question is, what should you be doing while you're alive now to minimize the taxes you leave to your kids? Now, I just did a video on how to live tax-free on $50,000 a year in income. In fact, I even showed you how you could live on almost $60,000 a year tax-free. And we can even show you how to live on $70,000 a year tax-free. The issue is your standard deductions, my friends. When you are living on Social Security and minimal distributions from IRAs, you probably have more in standard deductions than you do in taxable income. That means you're wasting some tax-free money. All right, so if you have $26,600 of standard deductions and you have taxable income of $15,000, that means you have $11,100 of taxable income that you can receive tax-free to get up to your standard deduction. Because remember, standard deduction of $26,600, that means you can have $26,600 of income without paying any tax. So if you only have $15,100 of income, that means you have all that from $15,100 to $26,600. That is all tax-free. So there's absolutely no reason not to start pulling money from your IRA. I've seen this happen a million times. It drives me insane. So I ask them, where's your tax guy? What's your tax guy saying? What's your financial advice? Why are you doing this? You're wasting that money that could be pulled out tax-free that either you could spend, you could put into an IRA, Roth IRA. I don't know, but it's just wasted away. Now, if you don't have IRA money, that's different. But even that, you still have that money you could take tax-free. Anyway, you got to look at your 1040. You got to understand how it works, because if you're retired with an IRA and you don't have that much taxable income, you could be just missing out, and you need to stop doing that. So anyway, don't forget to subscribe. Sorry about the little diatribe on kids, but whatever. I love them, and I love being a dad, and you should too. Don't forget to hit the bell to be notified down there. Comments are always welcome. Thumbs up, thumbs up, thumbs up. If you want a copy of the book, it's the tax bomb in your retirement accounts, how the Roth IRA helps you avoid it. It is free. Just go to heritagewealthplanning.com. You'll see the pop-up that jumps out at you. I need your name, your first name, your email, and your state. Go to amazon.com. And you can look up, you'll get it free for Kindle Unlimited, And then if you want it for the regular Kindle, it's $4.49. And I can't guarantee you nothing, but I can imagine you'll save more than $4.49 on this book just in taxes alone. And then again, can get the paperback for $5.99. If you don't save $5.99 in taxes by getting the paperback, I don't know what to tell you. I'd be stunned. But hey, that's up for you to determine. So don't forget to go to Amazon and get that as well. See you next time. Thanks, guys.